what it really comes down to is like, what's your rolling equity balance? Because equity is like the equity that was put in the business at the beginning, plus or minus cumulative profitability, which is also called retained earnings, minus distributions, right?
If you're going from 10 million to trying to do 15 or 10 million to trying to do 16, if you haven't like made enough profit from the prior year to then have enough money to make that PO for that Q4 period, that's when you start to get into that issue. It's not that you can't be profitable doing that volume, it's just that you don't have enough dollars to have the ability to do that revenue. That's what often gets the most missed during forecasts, where you may find yourself in like a cash crunch.
Dylan, we're back, episode 7. What's happening?
We are back. Not much. I'm looking forward to chatting about this topic. I think you'll have a lot of good takes. I'm curious to hear about how you think about it. I know when we think about growth planning at Aplo, we're normally very much focused on the next like 3 to 6 months. I imagine you guys probably are thinking even further, longer term on that when you think about your plans and strategies. So I'm really curious how you kind of work backwards on a multi-year time frame. I'm pumped.
Sweet. Budgeting for growth on a multi-year time frame. Let's do it. I wanted to start by saying, I don't want to sound like Mr. Corporate Buzzword guy. All right, so let's just start by saying that. But like, it really all starts with strategy. What do I mean by that? Let me just tell a quick story, right? So like Guardian Bikes, when we used to sit down and plan out our longer range kind of strategic plan and ultimately budget, we had to talk about what was the strategic opportunity, right, of growing a D2C kids bike brand. So what were some of the strategic things we had to think about over a multi-year time frame? Where's our supply chain, right? And why? How long will we have patents? Guardian Bikes has a number of patents. How long are these patents going to last for, right? What other entrants might come into the market? How might the bike industry evolve? How might D2C evolve? Where is our customer? What is our flywheel, right? And how does that get cranking? I'm just throwing out some things that we used to talk about, because you have to start here. You don't just say, hey, I want to be at 100 million 5 years out, right? You do need to set numbers, targets, because it's for size and scale. To reverse engineer, that would be 1 million units, right? So to do 1 million units, what capacity would we need to have in our supply chain? So there's a capacity planning kind of exercise, right? But like what I'm pointing out here is starts with strategy, right? And then that yields numbers, targets. And then you start thinking from there, where do we tactically need to be at the end of year 1, 2, 3, 4, 5? And then, okay, so then where do we need to be at the end of Q1, Q2, Q3, Q4? So I just want to lay the groundwork of it starting with strategy. What is your take on it starting with strategy, Dylan, when we're thinking about growth planning over a multi-year time frame?
Yeah, no, I think the like working backwards from like what does it logistically take in terms of units and inventory. I think a lot of times it's easy for a brand to look at, say, like let's say I'm planning for 2 years, whatever the time frame is, and I forecast that I can be profitable in those next 2 years at my desired growth rate. Just because you're profitable doesn't mean that it's necessarily going to be easy to finance that growth, depending on how much cash you're pulling out in the process to be able to reinvest into that inventory. And depending on how that looks, it may actually get like tighter and tighter and tighter as you grow. And I think that a lot of like, at least like in the planning conversations I've been in, a lot of the times the focus very much is like how much year-over-year growth and how much profit. But it's not the key thing that's missed is how does that look in terms of making sure I have the liquidity along the way to actually be able to afford that growth or feasibly finance that growth. And I think that that is probably the single biggest thing that gets missed when doing these multi-year planning discussions. You also touched on like bandwidth and like being physically capable of making enough goods. That's another kind of area. If you're just sourcing from your supplier, maybe you have more confidence depending on who they are that you're going to be able to do that volume and it's kind of a non-issue. Although maybe at that point you should be thinking about diversification and having a few different sources. But if you're manufacturing yourself, there's a whole other piece of like, could I physically make that much stuff in this space? Could I Do I have enough equipment? Does my workflow have to change completely? How that looks over time. So I think a big part of it is going back to financing, and having that looped into the conversation. But then there's obviously the actual real world physical constraints as well.
For sure. So to add to this, when you're talking about planning on a multi-year time frame, you never get to the multi-year endpoint that you're planning for, right? You tactically make decisions today, this week, this month, this quarter, right? But it's about contextualizing them, right? It's about seeing ahead to what we have to do today to make several years from now possible, right? And so there's a couple components to that. One is, what are the checkpoints along the way? Are we on track, right?
Yeah.
So those are rough revenue goals to be like, hey, at the end of year one, if I'm not here, getting to where I want to be at the end of year three is going to be really hard because that's a huge gap, right? So there's checkpoints. What Dylan referred to, there's capacity planning. Capacity planning is super important. I would say this is one of the most important things to make sure that you do in your multi-year exercise. And by the way, it doesn't need to be over complicated. Like at Guardian Bikes, when we were looking at 5 years out, we're like, literally simple math. What does 100 million in revenue look like? Well, our AOV is this. So divide that into revenue. That's this many orders, right? And it's like, okay, well, each order has 1.2 bikes on average in it, right? So that's this many units. And it's like, shoot, okay, so in 3 years, we got to be doing 500,000 units. Our current factory, we already know, can do this many per day, right? And with holidays and stuff, they can only make 250,000 units. So why is that important? Not that we have to go get another factory set up tomorrow, but we definitely got to be ready to hit that 3-year goal. So we got to start having conversations internally with our factories, right? Ultimately, Guardian decided to start its own factory because we started running the numbers, and amongst other things, we're like, hey, we need to start our own factory, and that was a 5-year endeavor, still going, right? And so it's about putting today's decisions, today's activities, this quarter's goals, this year's goals in context of the bigger picture, and in large part, it's a capacity planning exercise to make sure that you're getting out ahead. You're trying to remove future capacity constraints, right? I think another thing, and I want to turn to the ad side of things, is when you start running some of those numbers, usually some light bulbs start turning on. I'm like, okay, can we do this many units in this channel for a sales channel standpoint? Can we do this many units? Can we spend this many dollars at this full funnel ROAS in this ad channel, right? You never know the answers to those questions, but you can start questioning your assumptions and going like, man, that feels hard to do. Like, what are your thoughts on some of that, or what comes to mind when I say that, Dylan?
Yeah, so diminishing returns as you scale are a real thing. There is a world where you have diminishing returns and they continue, but there are other efficiency gains at scale and growth rate gains that can actually help make up for it. So I'll give you an example. Let's say you're a not so lean DTC brand and you have fairly high OpEx, but you're confident you can grow into it and you're still profitable, so it's okay. Sometimes, even with the diminishing returns on acquisition efficiency, as OpEx as the percentage of revenue decreases, it kind of makes up for itself, sort of. So as you lose margin on selling goods from a variable margin standpoint, you make up because you're having more going towards covering your fixed costs. So that can kind of make up for some of it. The other one is, let's say you've been growing, I don't know, 80% year over year, and you're modeling out to get to 100 million and you're at, I don't know, low 8 figures or mid 8 figures. All of a sudden, if you go from growing 80% year over year to maybe the next year's 50, the next year's 40, the next year's 30, and then you get to your outcome, you might actually see return customer revenue as a percentage inflate if you have high enough LTV. And then all of a sudden, you're still growing, albeit not as fast. And you have this other kind of customer bucket effectively, to some degree, subsidizing the loss in efficiency on first time. So you're doing more total profit and you're still growing. But that's arguably not sustainable because at a certain point, you're going to reach some plateau with that. But if you are only thinking about a certain number of years into the future, you can kind of play with OpEx and play with the growth rate in LTV to still grow and keep profit in the right direction. But when you're thinking about real limitations, let's say you're already capped out on OpEx, you physically cannot have less, and you maybe you're not super LTV dominant, or you've just been plateaued for a while, so you're not really getting that compounding benefit anymore from LTV because there's more people leaving than there are staying or something. At that point, that's when you have to start thinking about, okay, if I'm going to go and plan for multi-years of growth, you can look for channel diversification. So are you going to go and sell on the Amazons of the world? Are you going to go and sell in wholesale or wherever? Other things are you going to look into new products? So if you're expecting to only be able to sell so much of this product based off of TAM or some other research, maybe you launch another product, or maybe you just hop into another geographic market as well. So a lot of the times, although international is not going to be like the majority of a lot of brands' revenues, a lot of the time it can be some of the most profitable revenue. Obviously, it really depends brand to brand, and some markets may just not work depending on what you're selling. But that is also another opportunity. So I think when you're doing that multi-year planning, you really have to think about planning for the diminishing return, unless you're some brand where there's some crazy like network effect. And as you get more customers, you have more referrals from other customers. Like there are probably some outliers out there, but for the vast majority of brands, you're probably going to see diminishing returns. So you have to make sure that you're either creating margins somewhere else to make up for that, and or thinking about what's next to kind of supplement with other offers and or begin selling other places where there's more low-hanging fruit where you can get more margin per unit sold. So that's why I would think about it. There's multiple kind of ways to kind of position yourself to have bets that are placed outside of just accepting the diminishing returns, but you definitely have to plan around them.
Yeah, I mean, again, I think that's another big reason why you have to come back to like thinking about like how this all starts with strategy. This isn't, I don't know why this is so prevalent. I'm literally like thinking about this in real time in my brain. Like, I don't know why it's so prevalent in D2C. Maybe it's prevalent in all verticals. I don't know. But like I think people think scaling is just about just growing revenue and profit will come and like that's a good business, right? When in reality, like you have to think strategically about why scaling is a good idea, why scale exists, what scale is going to do for you as you continue to grow, right? So like for some people, for some brands, it's that like you can achieve economies of scale in your variable cost structure, right? And maybe at some point, when you get to you've done some analysis, and when you get to, let's just say 50 million a year in revenue, you've determined that opening your own warehouses will actually cut your shipping and fulfillment costs, by 20%. And there's that unlock of margin that you're talking about, Dylan. Or once you get to a certain scale, you're going to start making your own product, or you're going to negotiate down the per unit price with your vendors, right? Like I think the point I'm making is there's got to be strategy around it. It's not just grow, and you hit the revenue and like, oh, if your blended ROAS is above your break even point, like you're building a good business. No, you got to think about the strategic. I mean, I again, I don't want to sound like a corporate buzzword guy, but like the flywheel, the concept of the flywheel is like, how is your business building more momentum, right? As a generator of economic value as you
Yeah,
continue to scale. You know what I mean?
yeah, I think that is like I think the answer to it, or not the answer, but when you go back to strategy, part of it is acknowledging what are all the levers I have to pull, and I'm going to go and
Totally.
try to pull all of them because I don't know which one's going to bear fruit, especially with new products. So like I at Aplo Group, we work with a lot of very talented operators, and a lot of them are very much product people and very focused on developing new great products for their customer base. And even like the best ones have very low hit rates in terms of developing new top selling products. And I think that people dramatically underestimate how many products you have to launch to find new winners. So this goes back to this, like one strategy is like how do you operationally get into a workflow where you are launching a lot? And like we could define a lot, and it depends what you're selling. Like some things are easier to make new products of than others, like clothing and apparel, maybe a little bit easier than if you're selling like a hard good tech product or something. But like you you one of my favorite ways of thinking about it is like instead of being like emotionally attached to product launches and saying I feel like this is going to go very well and making
Totally.
big POs in the new products is like making a ton of new products with a ton of small POs and using that sales velocity to validate demand before going and doubling down because you may let's say there's like a scenario where you like just focus on something and this is like all I want to launch, your hit rate might be a little bit better. But if you're launching like 10% of the products that you would be if you were on like the fast model, you're probably going to get way more wins if you go on the fast model and 10x your output, or obviously maybe 10x is too much, whatever it depends on the industry. Directionally, more product is better. Now, it still has to be good. It's the never-ending balance of quality and quantity. But I do
Yeah.
think that's one of the easiest ones. Is just like a lot of people make too large of POs into a new product. You're better off making a ton of small POs. Has been my experience, but launching more. I'm curious what you think about that.
It's funny because when we were recording episode 6, I opened our document that we have for, tracking potential topics, and I wrote down
Yeah.
like new product development strategy, the risk adjusted approach. Because it's funny, everything we end up talking about on this show, we always end up at risk adjusted returns. But you know why? That's what scaling is. It's like scaling is investing in your business, right? And you have to think about it from a risk adjusted return standpoint. And I would say that what you just outlined from a new product development standpoint, it's like figuring out how to think about launching products from a risk adjusted, returns approach. And like if there's very high uncertainty about potential financial performance, you place smaller bets, right? And you kind of use the classic startup like test and learn and then iterate, strategy. Like honestly, man, the more that I grow businesses, the more that I realize that like none of us have a playbook that answers every single question about how to scale. Even the guys that you follow on social media who seem to have it all figured out, they don't have all the answers. And actually, if you dig into like how they achieved success in multiple business ventures, you'll find that they're willing to place smaller bets to learn, right? And figure out once they've landed on something where they should place a bigger bet, and Dave Ramsey has this analogy. He talks about musket balls versus cannonballs. And the story he tells is like back in the day, when ships got into cannonball warfare, you never just loaded up your cannonball first. Why? Because you had a limited number of cannonballs and then a limited amount of gunpowder. And so what you would do is you would load up these small musket balls and you would dial in how much gunpowder you needed to get that musket ball to hit the enemy ship. And you had to try a bunch of times. And once that musket ball hit, you're like, load up the cannonball, right? And so you can make sure you don't waste your cannonball. It's the same exact analogy. I mean, it's the same exact thing with launching new products in your business. Is like, shoot your musket balls, right? And then when you get a hit and you're like, all right, I think it's time to load up the cannonball, that's much less risky than just firing off cannonballs constantly, right? And
Yeah.
some of them hit and some of them don't. That's a whole lot. So I always like to use that analogy. Good old Dave Ramsey, man.
Yeah, it's a good one. It's a good one. Yeah, no, I think that, and again, I think in like recent pods, we've also chatted about like getting too long on inventory. And again, like the riskiest products, in my opinion, most commonly are going to be new products. Those are the ones that you want to be the most cautious around because there's no historical sales data. Like, how can you have an expectation? You can have an opinion, and I guess you always have an opinion, but you have a very uninformed opinion when you have a net new product. So it's definitely a balancing act for sure. What are your thoughts on like deciding when to try to start selling in? Well, I guess there's kind of two buckets. Is like when do you start thinking about, hey, it's probably time to start selling on other channels? And then secondly, when it's time to start selling in other geographies, how
I
do you kind of strike that balance?
I just opened my mouth right before to ask you the same question because
Yeah.
what I wanted to actually ask, because there's a debate about this. I debate this with different buddies I have in the ecom space. Like, what is the revenue number? Like I get asked this all the time. Hey, at what revenue number should I expand into physical retail? We'll start there, right? Or should I expand into Amazon? Those are the two most common that come to us at Free to Grow CFO. And I'm sorry, I know we say this a lot. The answer varies, but you should think strategically about your product category, right? What stage of the life cycle of that product category are you in, right? In these different channels, to the extent that you can, doing some TAM research. Example, Amazon keyword research can give you some ideas, right? There's different imperfect data sets you can pull to try to do a little bit of TAM research. And then you have to look and see who's competing in those spaces as well, right? And you kind of have to start there with doing a rough like kind of like TAM assessment to see if like it's no different than any other investment that you make. Is like, is the opportunity big enough, right? Because there's going to be effort, there's going to be costs. You want to make sure there's a big enough game that you're able to play. It depends, man. I've seen some brands get to 35 million D2C only and then decide to get into Amazon. I've seen others where they had to move to Amazon a lot sooner. But what was the deciding factor was where the volume was moving in said product category, right? During
Yeah.
that time of the life cycle of that product category online. And then the other thing is like, and I think this plays well into like the multi-year time frame planning subject that we're discussing here, is like when you start talking about physical retail, that is, it's, you don't just turn that on. It takes years, right? And so like I would say it's always okay, generally speaking, it's always a good idea to learn and research, right? Maybe have some conversations with brokers or other brands that are in retail. That's probably even, you got to be careful. Those brokers will sell you, sunshine and rainbows, and it never ends up turning out that way. But like you can turn on Amazon fairly quickly, right? You can turn on retailer marketplaces fairly quickly, the Target.coms, the Walmart.coms, that kind of stuff. But physical retail takes time. And funny enough, we're talking about placing bets with new products. When they're going to bring a new brand in, guess what they do? They test. They don't just place a super big order with you, right? They make you test on their .com store first, right? Which has no inventory risk to them. They place smaller orders at the beginning and then scale up over time as they prove that you have sell-through and that you can keep up. And so like there's also other strategic considerations, like sit down with a CFO, do your homework, and project out the difference in profitability and cash flow of these other channels. That is super important, especially the cash flow piece, because like different channels have different cash flow. Even D2C versus Amazon. Like D2C, generally speaking, you get your payments from customers batched, we'll say every couple days, and it drops into your bank account. Amazon, you're waiting 14 days for that cash, right? And so like and then retail, if you actually get into physical retail, you've got 60-day payment terms, 90-day payment terms, 120-day payment terms. So I think the answer to your question is like, it depends, but what should you strategically, what factors and data points should you gather strategically? Talk to other brands that are in those channels, do whatever keyword research or whatever other data-driven research you can about the TAM and the opportunity, and sit down with a CFO like what we do at Free to Grow and like map out what does the profit and the cash flow of those sales channels look like. So I'll tell a quick story. At Guardian, we're not on Amazon anymore, but in the early days, we got onto Amazon Seller Central. We're a brand new brand, and we wanted to just get exposure. So it was more of a brand awareness play that we felt at the time you could get brand awareness on Amazon very cheap, right? And so we got on Amazon Seller Central, and then we got into talks with Amazon Vendor Central. That's wholesaling to Amazon. And we actually made a strategic decision to do what's called a direct import program, where they had their MOQ to us, Amazon MOQ to us was a container. So like they had to buy at least a container at a time. For us, that was like $500,000 in revenue at one time. And so what we did was we basically said, we strategically decided we would do Amazon Vendor Central for like about a year, because we worked out a deal where we could invoice Amazon when it got to the China port and not pay our vendor yet, but then we could factor that receivable and borrow 80% of it before we had gotten paid, pay the factory, and then wait 90 days for Amazon to pay us. And so we actually use it as a financing mechanism where we are able to like take the receivables financing and pay our factory instead of taking that cash out of our own bank account. And so we knew we would not be on Amazon Vendor Central forever because we wanted to be a D2C brand for strategic reasons, but we strategically used Amazon Vendor Central as a financing mechanism because we put the right AR financing in place. And then we moved off that channel and scaled up our D2C further. But what's the point I'm making? Multiple strategic considerations, right? Profit, cash flow, life cycle of the business, life cycle of the product category in those channels. So what are some of the things that you think about with channel or like international expansion?
Yeah, I think that Amazon is often agreed the easiest. In certain categories or in certain scenarios, it becomes a measurement nightmare. So
Totally. Yeah.
like you'll start to have some customers, like I'll speak for myself. If I can get same day or next day delivery, I much prefer that over buying on a Shopify store or whatever. So if I see a product I really like, I will occasionally look on Amazon and see if I can get the exact same thing and have it get delivered like that. So when you have customers like that, especially when you're potentially selling something that people are more frequently wanting to get urgently and it's less time sensitive, you basically are in a situation where you may begin to have some spillover. So how do you measure that? And then how do you measure that with your Amazon spend? So generally, I think the path is like you have to start looking at Amazon and D2C performance together and measuring some of
Totally.
those things together. And if you don't, you can start getting kind of some mixed messages where maybe your business is actually doing well as everything together, but D2C looks worse because you're having some percentage going towards Amazon. So that's one thing. And I can get into like Amazon product strategy. Do you hold out some products? You have different products, different bundling setups, so there's enough differentiation where it kind of discourages that shopping on Amazon. It's definitely a balance. So that's less so about when to do it, more so about a consideration when going to Amazon. I think that if you're in a position where you're kind of like exiting seven figures into low eight figures, you may still be looking at where you're at currently. You're not really suffering too much from diminishing returns on acquisition. And it's just like it's too effective to just double down on D2C and just focus on that. But I'd
Yeah.
say where we often see brands start thinking about getting into other channels, it's often somewhere between 5 and 25, that kind of range, $5 and $20 million a year, where it's like if you were D2C first, somewhere in that range, you're often starting to kind of assess Amazon and or wholesale. But I totally agree, it depends what you're selling. Like if you're selling like food and bev or something that can be sold in grocery, oftentimes brands are going to make a jump there pretty early in their journey, just because from a TAM standpoint, often physical retail is probably going to be a lot bigger than D2C. So it really does depend, but I'd say directionally there's that. And then international, I just think is a thing that often gets missed in terms of an opportunity. For a lot of brands, international is by no means going to be the majority of the sales. Maybe it's 20%, 15%, 10%, 25%, whatever. But oftentimes that can be some of the most incremental sales that you can get in terms of low-hanging fruit. And it depends what you're selling. Some things are harder to sell in other countries than others. But if you have a product that can easily be sold in other countries, and like maybe you set up a specific 3PL somewhere to do it, like oftentimes that can be a great opportunity. Maybe you validate it by shipping goods from the States or wherever you're based initially, if you can, even if the shipping economics don't make sense. But if the ROAS are there, all of a sudden, if you set up domestic logistics, you get the variable costs in check, and then all of a sudden you have another location that you can successfully sell to. Where the how far along the journey brands often go international in our experience is just directly related to how easy it is to sell there. But I think it's often something that gets overlooked. If you're getting diminishing returns, you think back to the day of, oh, I remember when I spent $2,000 a day, $5,000 a day on ads, and I had such high efficiency, and now I'm at 25K a day, and it's good, but it's not the ROAS I had at 2K a day or 3K a day or whatever. Well, there's other countries that you can sell at 1K a day a spend or 2K a day a spend that may have efficiency similar to where you were back when, as long as the variable cost makes sense to sell in those countries, and the purchasing power is there, of course, and the conversion opportunity. So I think it just comes down to what you're selling and how easy it is to sell in other places.
Yeah, so a couple hacks. Or I don't want to say hacks. There's no hacks in life, unfortunately. You got to be disciplined and work hard for a long time. But a couple tips to consider. One, if you start seeing scale in another country to enhance the variable cost structure, raise gross profit margin, ask yourself, again, thinking about a multi-year time frame of planning here, could you set up a supply chain, a more localized supply chain, right? And at what volume does that pay for itself? Right? So like a lot of brands that are much larger, if they have a sizable EU business or business and then a sizable US business, they actually have their products made for the EU and the UK in a different country. So also tariff considerations, a very common strategy is like brands make stuff in China for their US market, maybe not anymore with the Trump tariffs, but I'm talking about historically. But because there's punitive tariffs on China in the EU, they don't make those same products in China and ship them to the EU. They may make them locally in a European market, or they might make them in India or somewhere with a more favorable tariff rate. So that's something to consider. The other thing is like We just talk about like risk adjusted bets, placing smaller bets when there's more uncertainty and you haven't had like data to prove out that you should scale something. The musket ball approach is try Amazon FBA just to test a market. It's not usually the best thing to scale because economically, going back to the variable costs, like oftentimes you can do better by going DTC in another country. But if you do want to just test, right, and send like a little bit of inventory to whatever, Amazon FBA UK, and just give it a shot just to see if your products even, can even, get some traction on Amazon, that's another thing you can consider as well. Yeah, man, I think the last thing we haven't touched on is financing growth with retained earnings versus taking distributions over a multi-year time frame. By the way, if any of you listening did not listen to episode number 5, how much money should you pull out of your business and how that relates to ROAS, definitely go back and check out that one. So we won't get as much in the weeds on this. But I would say from a CFO perspective, going back to something that Dylan opened this episode with talking about like, can you finance your multi-year projections? I would say when you start talking about how to think about financing the business's growth over a multi-year period and whether you used retained earnings or not, is to work with a CFO to do a simple multi-year cash flow forecast. Now, keep in mind, this is not, let me tell you what this is not. If you're talking about a 5-year planning horizon, this is not a 60-period monthly cash flow forecast, right? It's maybe it's quarterly. It's literally starting with an annual cash flow forecast. And it's identifying what are the major drivers of your brand's cash conversion cycle, right? And so it's like you have an annual rough P&L forecast going out 5 years, and then you have an annual cash flow forecast built off of days inventory on hand, days financed in your payables, and days financed in your receivables if you have any of that stuff. And when you start thinking about a multi-year time horizon, this is important because you may go in year 3, we're thinking we would have 33% of our business is retail, right? With 90-day payment terms. So you want to build that into your forecast, right? And what you can do, it's not going to give you all the answers, but what you can do is you can start, again, going back to what Dylan was saying at the beginning of this discussion, you can start seeing if your business as it scales, even though it's more profitable, is it increasingly consuming more cash to get to that profitability, or is it generating more cash, or is it neutral? And then you can at least start thinking to yourself like, okay, we're going to need some receivables financing most likely if we're going to get that big into retail. And you can again start thinking in broad brush strokes of like, what could we do to get inventory levels down as a number of days of inventory? Could we increase our payables days because we're bigger and we can finance better payment terms with our vendors? So you're not going to come up with a list of tactical activities, but doing a rough annual cash flow forecast will go a long way in helping to think high level how to finance the growth of your business over a multi-year time frame.
Yeah, and to also put it into D2C speak, and let me know if you think I'm off at all on this, John, but like back to the point I made earlier where you forecast out 2-3 years and you forecast out revenue growth and profit. The financing piece where it often breaks down for most brands in my experience is that pre-Q4 ramp up where maybe you're a business that not only does a sizable percentage of the revenue in Q4, or maybe it's not even a sizable, maybe it's just the most profitable revenue in Q4. Like if you're going from, I don't know, going from 10 million to trying to do 15 or 10 million to trying to do 16, if you haven't like made enough profit from the prior year to then have enough money to make that PO for that Q4 period, that's when you start to get into that issue. Is it's not that you can't be profitable doing that volume, it's just that you don't have enough dollars to have the ability to experience trying to do that revenue. And that's where the timing and all of it is key. And I think that's what often gets the most missed during forecasts, where you may find yourself in like a cash crunch, so to speak. So does that make sense to you?
Yeah, so like what it really comes down to is like what's your rolling equity balance? Because equity is like the equity that was put in the business at the beginning, plus or minus cumulative profitability, which is also called retained earnings, minus distributions, right? And so you can do a rough, like what Dylan's saying is like, let's say you have $1 million in equity when you start this planning exercise, and then you're planning on making K over the next 3 years. But then let's say you want to distribute to yourself 1.25 million. you only got 250K of equity left in the business at that point. And if you determine you need to spend $2 million on your PO for the holidays, you only have 250K in equity in the business. So that capital's got to come from somewhere else, right? So those are just some rough random numbers, but there is a way to think through, or you even to think about the peaks and valleys of inventory purchasing cash flows, right? And kind of roughly back into like, are we even generating and retaining enough profitability for us to even finance this without debt, right? And so that's really important. I would say like two, usually when we're doing long range forecasts as CFOs, if your brand's super seasonal, we'll start annual and then we'll go to quarterly. We usually don't get like more granular than quarterly because it gets the assumption engineering is just too crazy. But quarterly usually does the trick because if you're seasonal, you can have like, you can show like a down Q1, a bit of a ramp up in Q2, maybe a nice, and then maybe really valley in Q3 and then a big Q4, right? And you can kind of do a rough cash flow and P&L forecast quarterly going out, say 3 years, 4 years, 5 years. So yeah, man, any other final thoughts that you have on your end? I think this is a good one.
Yeah, no, I think I think we covered everything. I guess like closing statements and thoughts are make sure you do both the P&L forecasts, backing that up into what it takes to get there, but then making sure you don't forget the financing part because time and time again, as people who don't sit in like the CFO seat, I see that's often the thing that gets forgotten the most. So it's just crucial that you have that as part of the plan.
Totally, yeah. And I would say my final thoughts are good old Dave Ramsey, musket balls. Calibrate your musket balls before you fire your cannonballs. And then also, when you're talking about planning in a multi-year time frame, starts with strategy. What's the opportunity, right, in all these different areas of your business and in the marketplace? And a big part of long-range planning is capacity planning. What capacity do we need? What's the size and scale we're going to be at? And not because we need to go get all that stuff done today, but because there's stuff that you need to do now, this quarter, this year, this month, to enable that, right? So I think if you can follow some of the tips and tricks we talked about here, I think you're going to find yourself easily in the top like 1% of brands when it comes to planning sophistication. So yeah, man, episode 7, this is a good one. Already excited for the next one.
Yes, sir.